Hello, everybody. Welcome to this webinar brought to you by Bursa Malaysia. My name is Shen Chu. I'm the moderator for this webinar. Our webinar today is titled 2023 Bond Market in Retrospect, Identifying Future Market Dynamics. So as the title suggests, today we are going to review the bond market in 2023 and gain insights into the bond market for 2024 and learn what would be the potential market risks that could entail in 2024. So before we begin, disclaimer, whatever we share in this session is only for educational purpose. In no way that I give any recommendation for you to buy or sell any listed securities that I mentioned here. If you decide to make any investment decision, you're 100% responsible for all your investment risk. Today, we are very honored to invite a very accomplished investment manager to join us in this session. She's none other than Miss Joanne Gan. Now, Joanne served as an investment manager at Opus Asset Management Sdn Bhd, boasting more than 14 years of expertise in treasury, investment, and research. She earned her Bachelor of Economics from the University of Queensland and holds the designation of CFA Charter Holder and CMSRL License Holder. So, Joanne, how are you today?
Hi, Shane.
Hi.
Hi, how are you? I'm good.
Yeah,
How
I'm
are you
good.
doing?
Yeah, thanks for asking. So we are all set for your session. So I'll just hand
Hmm,
over the floor to you.
let's do it. Let me just share my screen for now. Okay, it should be shared now.
Yes, perfect.
Okay, thank you, Shane, so much for the introduction earlier. Okay, so hi everyone. Thank you for joining my talk today. This is the title on my talk, which is 2023 Bond Market in Retrospect, and also to identify future market dynamics. So moving on, this is going to lay out the agenda of my talk today. So this is a message that we've been giving all our clients in 2023 recently and also into 2024. So cash is king, but bond is better. And I hope that throughout my session today and throughout my presentation and slides, you're able to see this message a bit more clearly as to why we're giving this advice to all our clients in 2024. So my outlook for market review and outlook will be the first part of my talk today. And then to identify future market dynamics, we'll go a bit more into the bond market outlook. And then further for the third topic will be on key market risks in 2024 and kind of summarize my presentation today under the conclusion. So let's go to our market review. So first point up here, we see that there's surprise resilience in the GDP growth, especially in the US economy. So I'm going to elaborate a bit more on all of these points in a couple of slides after this. Second point being global inflationary environment is moderating towards the central bank's general target of 2%. On the third point, you see that rates have peaked and it's going to remain higher for longer. Interest rate yields are higher for now with all the central banks' aggressive rate hikes, but we do think that the rate cycle is nearing its end. The fourth point will be on Malaysia's growth resilience, a bit more closer to home. Our growth target for this year is 4 to 5% for GDP growth and for inflation to be within the projections of 2.8% to 3.8%. So the bond market in Malaysia this year has done amazing. It's a great year for the bond market. And if any of you are invested into a bond fund, you have seen returns of about 5.5% to 6% year to date as of November this year. So a really great time for bonds this year. And we're going to see that in 2024, it's going to be a great time for bonds as well. So global growth remains mixed, but remains resilient over in the US. You can see here there are a couple of countries that we do track, and namely US, the Eurozone, China, and Japan. And there's also 3 periods here that we track, which is from 21, 22, and 23. So maybe I'll just bring you to the chart here to bring a focus to how the growth was in 2021 post the reopening of economy post-COVID. So you can see that in 2021, when the economy reopened, global growth in general across all 4 countries that we track are quite positive. But as the demand increases, as inflation becomes an issue, you will see that their central banks have started their rate hiking cycle in 2022, and this itself has impacted global growth. So global GDP growth has generally slowed down in 2023 over here in this part of the period on the chart. But we see resilience in US. So this blue chart is showing the US GDP growth, and the latest third quarter GDP growth is at 5.2%. And why is it so strong? It is from business investment, government spending, and consumer spending remains very robust in the US market. However, a different picture is coming out from the Eurozone. So the Eurozone one would be the purple bar here, and the latest quarter, unlike over in the US, is actually at negative 0.1%. So Eurozone, unfortunately, is sticking into a recession fear, and this weakness is coming from the manufacturing and also services sector. And business sentiment remains quite weak over in the Eurozone. The red chart denotes China, and China's fiscal health remains weak. They reopened their economy this year, but it remains quite weak. But the PBOC, which their central bank, has been trying to stabilize the growth, and they've actually gone through a rate cut cycle in China itself. However, property market stress continues to drag down the economy. So on the next slide, kind of like the four countries that we were speaking about earlier, I wanted to show you how the trend is, because all four countries are having slightly different trends, showing that it is still a mixed global growth and the strength is coming from the US market. So if you just follow me to the top left-hand chart over here, highlighted here, you will notice that the quarter-on-quarter growth in US is very strong, and year-on-year as well. This showing kind of like a resilience in terms of the US market, very unexpected for 2023 because the yields in US are relatively high, but the job market seems to be the one that's pulling up global US growth over there. And the Eurozone, however, is a different picture. You will see that it is trending lower towards zero, and as mentioned earlier, the last quarter in Europe is actually negative 0.1, kind of sparking potential recession fears over in the Eurozone. In China, remains quite mixed. So if you track Q1 and Q2 numbers, it was positive and then it drops down slightly. So over in China for this year, the outlook is that it's slightly dim. However, having a growth of about targeting about 5% for this year, it is generally quite good, coming from a part of a time period when global growth in general is slowing down across some of the advanced economies. In Japan, similar story to Eurozone, there's a drop in quarter-on-quarter growth. And Japan itself is also not seeing much growth, and the inflation itself in Japan is also quite low. So let's go a bit more, diving deeper into US and where is the strength coming from in terms of the growth in the US market. So the strong growth comes from a very resilient labor market. So how do we track the labor market? So I track it by using some of this data over here. Generally, these are similar data that economists would track, that you will see in headlines coming up from all sort of financial news providers as well. So we look into the blue graph, which is the NFP, standing for non-farm payrolls. And non-farm payrolls measures the change in number of people employed during the previous month. And if you would just go into this highlighted part, which shows kind of like the recent trend that you will see in the last couple of months and in the last quarter, is that it is stable and quite positive, showing that the labor market in US is actually very resilient. You can see that the next thing that I do track is the jobless claim, which is initial jobless claims number, measuring the number of individuals who file for unemployment insurance for the first time in the past week. So if, let's say, someone were to lose their job, they will do this filing. But I think the thing here is also when we look at charts, we look at the trend, and the trend shows that this bar chart is not deteriorating. There is no increase in terms of unemployment jobless claims, and the unemployment number rate is also strong at 3.9%. So this 3.9% was actually a previous data. The last Friday's data came out even stronger at 3.7%. So the labor market in US is going very strong, over and above expectation. And what does this mean in terms of like, how does it pull growth? How does it impact Fed's decision when it makes decision as to whether to pause rates, to hike rates, or to cut rates? So a strong labor market is positive for consumer spending, and a strong consumer spending is positive for US growth. So there is no need for the Fed to cut rates yet in the near future, because the US growth is still strong from this strong labor market. Hence the mantra for higher for longer in terms of rates in the US market. But why is labor market indicators so important? It is a key to gauge. So you will look at the labor market in terms of whether it's stronger or whether it's weaker, and this will show you sort of an indicator when Fed will pivot from a rate hike cycle to a rate pause and then a rate cut cycle to support the economy in the US. So going into a bit more domestically, this is on Malaysia, showing our growth in terms of GDP, tracking it from last year up to the latest third quarter of this year. So third quarter GDP is still very resilient at 3.3%, is underpinned by resilient domestic demand. So if you just follow me to this furthest part of my chart over here, 3.3%, and where is the growth coming from? So you look at private consumption, it is the only row that will show probably positive numbers for every quarter that we've been tracking. Although notably it has been trending slightly lower, the number has gone from double digit to single digit, but it is still positive nonetheless. And private consumption is showing improvement in terms of both necessity and discretionary spending by households. In terms of other factors that's leading to this strong third quarter GDP growth is in government spending, where government has spent on fixed asset spending. And we've also seen some business continuing its capacity expansion and also capex by public corporations. The only number that's a bit negative here will be export and import figures being negative this entire year for all 3 quarters that we've been tracking. But I'll explain a bit more in the next slide how we see that the export and import numbers are actually showing a bit of a positive growth in terms of the trend that we see. So here, again, I want to talk a bit more about private consumption because it is a key to why our GDP growth is still quite strong. Again, a reminder is that 2023 target for GDP growth in Malaysia is within the 4 to 5% of projections. So here, the private consumption, although trending lower, it is always showing a positive number, and it shows stability in recent quarters. The percentage of share of GDP is also higher from 59.7 to 62.4, just to show that private consumption is an important factor in terms of what feeds into strong GDP growth in Malaysia. So then now we look into export and imports because again, it was negative in the last couple of quarters, but export and imports are very cyclical in nature. It follows business cycles. So here we track since 2020, which is since the reopening of economy in 2021, and then you see bouts of spikes in terms of activity of global trade, and then it slows down again, and then there's a bit of a spike in 2022 again. So it follows a it follows the business cycle. And now because of the weakness in global growth, and generally a slower trend in global demand, and also China not being having that spur in demand recently, there is a drop in trend in terms of export and import. But you will see that there's slight improvement in the recent data. The export number is less negative at negative 4.4, imports at negative 0.2, just to give it a bit of positivity in terms of export and import figures, that we do think that there will be an improving export outlook that will support GDP in Malaysia. So now we want to look at global growth projection. So to look into projection, maybe I want to bring everyone back to historically, what is a typical global growth that you will see across the world on a normal time basis. So here we've tracked 3 different decades, and you'll see that in 1990 to 1999, the kind of growth that you will see globally is about 2 to 3%, and it's slightly higher in 2000 to 2009, and it's also even higher just the time period before COVID hit. So 2010 to 2019, the return is about 3.2 to 3.7%, and subsequently COVID came, and you see that growth fell, and 2021 it recovered. And because of the hawkishness of central bank hikes, because of how high interest rate environment is, you will see that global growth will trend lower, as we have seen this trend in 2022 and 2023 as well. And in 2024, IMF and World Bank is projecting for global growth to be below 3%. So IMF projects it to be 2.9%, and World Bank projects it to be 2.4%. So where is global growth coming from, or rather, where is it not coming from? It is not coming from the manufacturing sector because the outlook remains quite dim amid weak global demand and geopolitical risks. How do we track manufacturing sector activity? We look at this data called the Global Manufacturing Purchasing Managers Index, which is the global PMI. And how do you see this number? Is that there is a number of 50 that kind of separates whether the sector is going through a contraction or expansion. So a number above 50 will show that the sector is expanding, and the number below 50 shows that the sector is contracting. And here you will note that global manufacturing PMI is below 50. It's kind of showing that it's below the threshold of 50 for the past month. It's slowing down, showing contraction Similarly, you see that in US and also in the Eurozone. So this slowdown in industrial production is due to weakening in world trade as reflected by recent trends in US and Europe. You will see that China's slightly better numbers at 50.7, showing that in China itself, manufacturing sector is actually okay and expanding. All of this weakness in manufacturing sector just kind of supports that moderate global growth outlook that we've seen earlier being projected by IMF and World Bank. However, some couple of good news will be services sector being very resilient in 2023. So global services PMI is also something we track to show whether the services sector is expanding or contracting. So this number above 50 shows that the global services PMI remains quite robust as consumer spending continues into the food and beverage sector and tourism sector instead. So US similarly showing above 50 at 50.8, China at 51.5. So these two countries are showing expansions in terms of services sector, but in Eurozone, unfortunately, again, it is a number below 50. Just showing weakness in Eurozone. Again, this tie up to the story that earlier we spoke about how Eurozone is going to some recession fears, and this is because of weakness in both the manufacturing and services sector. So what are services sector? Services data are based on surveys, which covers things like transport, communication, financial intermediaries, computing, hotels, and restaurants. So after going to talking about global growth, we're going to talk about inflation. So here I have two charts that shows headline inflation and core inflation. So I think we just shift our focus to the left side of the chart, going through the headline inflation. So when we look at charts, we like to look at trends, and the trend is our friend over here because you can see that there's a very clear downward trend in terms of inflation going towards central bank's target of 2%. So why is inflation so important? Because the only reason why central banks have been so hawkish in 2022 and early parts of 2023 is to control inflation, is to bring down all of this demand and economy that is too hot. That's why they hike rates. But now that we see inflation trending towards their target, we can see this goes into our feed to why we think that interest rates have peaked and central banks are probably going to hike for now for a while. So US CPI is actually quite encouraging at 3.2%, Eurozone at 2.9%. You see that UK is at 4.6%, and then Malaysia within target of 1.8%. If you go to the right, which shows core inflation. Core inflation is something that perhaps central banks track a bit more because core inflation strips out volatile items such as food prices and energy to show kind of like at its core, what is the inflation that's driving the economy. Similarly here, it's slightly mixed, so the trend is not as clear as we have seen in the headline inflation, but nonetheless, it is still showing a downward trend. In the US, the core CPI is at 4.03%, Eurozone is at 4.2%, UK is at 5.7%, and Malaysia again within the target of 2.4%. So speaking a bit more on the US core CPI, because again, the Fed is one of the countries that has been the most hawkish in terms of its rate hike cycle. And this is because their CPI, the inflation has been so high. And one of the reasons that was pressuring up inflation in the US was from housing prices and also rental prices. So this is something that we track, which is the Zillow observed rents. They're a bit like our property guru, where they will just track monthly rental rates in the US. And the rental rates is showing a downward trend. So when there is a downward trend and there's a decline in rental prices, this will take pressure off inflation in the US. However, one of a key component that still remains a risk, giving somewhat of like an upside risk to inflation globally, will be oil prices. And oil prices in general, we track the WTI, we track Brent, and they're around the $70 at the moment. But it does spike. It is quite volatile depending on headline, and this depends especially so on geopolitical tensions that you see in headlines. And this is reflected in 2022, where there's a bit of a spike in terms of the Brent crude oil prices and WTI. They've come off subsequently, but recent times, we have also seen that spike. So any spike to energy prices, because energy price is a very big component of inflation globally. So if it goes up, inflation will be staying higher for longer as well. But for now, you can see that the trend is that oil price is coming down below some of like the moving average that you see over here. So for now, it is not a problem to inflation, but it's something that you should look out for in case there are any headlines, in case there are any sudden spikes to oil prices globally. So let's talk a bit more about what central banks have been doing to control inflation, to kind of like balance between inflation and growth in each of their respective countries. Here I've compiled a table that kind of breaks down the country and what it has done, what is their latest policy rate, what is the inflation trend, and when was the last time they actually hiked rates and by what quantum. So the top three will show the advanced economy in the US, Euro, and UK. And we have Malaysia over here. And the countries below are just some of our regional peers that we look at. We want to compare how hawkish or how the decisions have been made compared to Malaysia. So perhaps I just want to show that central banks have mostly slowed down because of a lower trend in inflation. And as highlighted over here in this column, and as mentioned before earlier as well, that most of the inflation in most of the countries are actually trending down towards the 2% target. So it is a great, very encouraging data. And you can see that in these two columns as well, if I bring your focus to it, in terms of when was the last change of policy rate and what was the change. So in general, for this year, there were still some rate hikes, advanced economy in Malaysia as well, but the rate hikes have been paused for quite long. So in the US, they hiked 25 basis points, and this was back in July. In Europe and UK as well, they've hiked, but this was also back in August and September. And for Malaysia, the last rate hike that we did was actually only in May, and subsequently Bank Negara has actually paused their rate. So the only regional country that's probably just been hiking slightly more because of the inflation environment is Indonesia and Philippines, where they hiked by 25 basis points in October. And also maybe just shifting your attention to this chart over here to give you a bit more visual in terms of how hawkish some of the central banks have been. We can go through the red line here, which is the European Central Bank over in Eurozone. They were previously in the negative region, and they've actually hiked all the way up to 4%. And similar trend will be seen by the Fed and BOE, which is the Bank of England in the UK, also hiked from almost 0% all the way up to about 5.5%. So Malaysia is one of the only countries actually who has been very gradual and hiking rates only up to 3%, which is similar to where the interest rate environment was pre-COVID time. So here, I think I just want to show everyone what are the trends in central bank's policy direction since 2021. So on the top side, you will see in India, Philippines, and Indonesia, they've actually all hiked rates to relatively high levels, given that they've started at quite high levels as well in 2021. So the rates are about 6% over in these three countries. And at the bottom will be some of the advanced economy, where interest rates were almost at zero, but because of the inflationary environment, they've actually been very aggressive in hiking rates, like in the US, UK, and Australia. So similar story that you will see in Eurozone, as mentioned earlier, and in Korea, and in Malaysia, you will have seen how gradual our rate hikes have been. And in Thailand, there was a bit of like a hike as well in 2023. But the other two countries that are actually quite different in terms of their story recently will be China. Again, post reopening of the economy, the growth and the demand has not been as great as predicted. Hence, the central bank in China have actually recently started its rate cut cycle to spur the economy in China. In Japan, similarly, they're still in a negative policy rate regime at negative 0.1%. Okay, now that we have gone through the financial market, sort of like what happened in 2023 and what we expect the financial market to be at. So what are the opportunities in 2024 and how can you make better investment decisions for 2024 to put your money to work in 2024? So this again is our message for this year to our clients, is that cash is king and bond is better. Maybe we'll look back into why cash was king in 2023 and 2022, because cash looked so enticing in the past 2 years from higher policy rates, and because of a volatility in the financial market, it makes sense to put money into cash where it is almost risk-free and giving you yields of about 4 to 5%. But because now the story is changing, we have to be dynamic. We have to start thinking about where our money works best and in what asset class moving forward. given that we have information, given that we know where the financial market is moving. So as interest rates fall in 2024, as a lot of financial market, if you read through, potentially the rate cut cycle may start in most economies in the second part of 2024. So when interest rates fall and risk sentiment recovers in 2024, bonds is definitely going to be a better investment than cash. So bonds itself, if you're already a buyer into a bond fund or you're already a direct buyer into a bond specifically, you will know that it provides stability in return, and the coupon payment generates income, and bond prices will rise, giving you that capital gain when economic growth slows, because when economic growth slows in general, central bank will start to cut rates. And by cutting rates, yields will fall, and for a bonds perspective, when yields fall, price goes up. So maybe let's look at where we see interest rate going, both domestically in Malaysia and also in the US. And the reason why we track US so closely, because there's such a huge correlation between the Malaysian government bond securities and also the US Treasury market and all the headlines that comes out from US. So let's move our focus to Malaysia first. So Malaysia's growth and inflation points towards a pause in rate hike for the near future. So here we track the Malaysia CPI, which is the inflation rate going towards the target, and also GDP, although it's trending lower, it is stabilizing towards the 4 to 5% typically that you will see in a normal time in Malaysia's growth. And OPR is at 3%. So we expect that Bank Negara is going to maintain their overnight policy rate at 3% for the rest of 2024. So what about US market? In the US market, the financial market is pricing in earlier and steeper rate cut in 2024. And how do we see this? So here, let's just go through to where Fed funds rates currently are. So on the upper bound of the Fed funds rate, it is at 5.5%. And then we go through Fed funds futures. So what are Fed funds futures? It is what Fed fund future rates will be being priced by the financial market. So in 2024, you will see that the Fed funds futures at 4.31. It is a drop from 5.5, showing that there is a price cut being priced in by the financial market. And because the 2025 is even lower, it means that the market is pricing in potential stages of rate cuts by the Fed in 2024 and 2025. So personally, our view is that Fed funds rate should have reached its peak for now at the 5.2 to 5.5% level, and to stay higher for longer, at least until first half of 2024. And then potentially, if let's say growth slows down slightly in the second half of 2024, the central bank, the Fed may cut rates by about 0.5 to 0.75% in second half of 2024. Okay, so knowing all of this, where do you put your money? Again, bond is better, and we do think that bond is a better alternative to cash, and it's time to lock in the yield. Time to lock in the yield, meaning that yields are already a lot higher now, domestically, globally as well, because of how high the interest rate environment generally is. So here, we've tracked the 5-year MGS. MGS stands for Malaysian Government Security. So the Malaysian government security is similar to the US Treasury, where it is a risk-free asset class issued by the Malaysian government. So the 5-year maturity of an MGS will give you about 3.63% in terms of yield, and a 3-year maturity MGS will give you about 3.5%, and this is in comparison to our overnight policy rate of 3%. So over in the entire time period that you see here, from 2013 up to 2023, bond as an asset class is usually quite stable, and the only time when volatility actually kicked in was because of the pandemic. And why we say that it's time to lock in yield, because the yield now is generally even higher than it would have been on average in the past 10 years that you will see here. And if you were to be invested into the bond market this year, we are a fixed income asset house. We manage bond funds, and we've seen that the Malaysian bond market has turned around so convincingly in 2023. So over here, we actually charted, we're comparing the Malaysian bond market using an index called the Bond Pricing Agency Malaysia, BPAM All Bond Index. So for equity, we have KLCI. We also have the ILMAS index for like the Sharia equities. And I think you have S&P for the US market as well. So this tracks the Malaysia bond market. And the BPAM All Bond market includes corporate bond issuances and also Malaysian government bonds. And in 2023, year to date, up to November, the market is already returning 5.73%, almost 6%. And for this year, we're projecting for the bond market to return a rate of about 6 to 6.5% for 2023. And this is over and above a 12-month FD rate of about 3%. So such a strong turnaround, because in 2021, there was slight negative return in the bond market, and 2022 was slightly low as well, generally at 1.5% only. But again, 2023, such a great return, an amazing time to be in the bond market. So earlier, the All Bond Index actually tracks all bonds in the market. It can be from a maturity of as low as below 1 year up to the maximum of about almost 30 years in terms of a Malaysian government bond security. So if you don't like to take time risk, you want to be in like the shorter sort of segment of a bond market, we also have an index that tracks 1 to 3 year all bond index. So this index includes bonds that are maturity is no longer than 3 years. And if you look at the annualized return of this particular index, it's already returning about 4% on an annualized basis. And this is over and above the Maybank 12-month FD rate of almost 3%, and also giving you a better return, covering a better rate than the inflation rate on an annualized basis of almost 2%. So over here, the two charts is going to show you what sort of return that you actually get from being invested into the bond market. And being in the bond market gives you that very stable and sustainable return, because bond does have that income component from the coupon income that you will get by being invested in them. So potentially, you will get that income return, and even more so, a better time now because yields are high. And if you were to lock in your yields right now, there is a potential for capital gain as yields shift lower in 2024. So why are we so confident in the bond market? So we want to look at what the bond market is in terms of where the demand comes from, who are the main buyers of the Malaysian bond market. So local players are such like EPF, QAP, there are banks as well, and also fund houses such as Opus Asset that we do buy into the bond market, invest into the bond market. But another component of demand comes from foreign investors, and we have seen such strong debt inflow, increasing by about 26 billion into our bond market this year. So here we track since December 2022, the blue one does show the bond demand inflows from foreign investors into our local bond market. And although the last quarter has been slightly negative, but in November it turned around, and we saw that there's actually 6.8 billion of inflow into our Malaysian government bond market by foreign players. So our Malaysian bond market is held by foreign players by about 25% of the total outstanding of the Malaysian government securities. So who are the buyers of, in terms of foreign debts, foreign players who are into our debt market, who are the buyers? So there are global asset managers. Some of them track our indices that we are involved in. So global asset managers, we also have central banks from other countries, pension funds, banks, and insurance companies as well. So all these are very sticky investors that are into our bond market for the longer term, because all these sticky investors are looking for long-term returns and also sustainability in returns as well. Let's go to the bond supply of where corporate bond issuances are in 2023. So what have been issued? So what can we buy? What can me as a fund manager buy for my bond funds? And what can you, if you're interested to buy bonds? What sort of sectors actually issue bonds in the Malaysian corporate bond market? So the bulk of it are from financials, such as banks. And then we also have energy and utilities, which are like the power plants, the hydropower plants, solar power plants. And there's public administration, which is government related, real estate, which is property, transportation, and also industrial. And in terms of how much they have issued this year, you will see that this is the gross issuance since 2018. Very encouraging. So even during 2020 and 2021 and 2022, when the market was recovering from the pandemic, you will see that there has also been issuances in our Malaysian corporate bond market. And year to date, we're seeing about 110 billion already being issued in our Malaysian government bond market. So next, we'll look at the rate slightly in the US Treasury market, where it remains inverted, but market is pricing in a rate cut in 2024. So what does inverted mean? We've heard this for very long. It means that the shorter end of the yield curve is giving you a higher yield than the longer end of the yield curve. So generally, the basic would be that if you hold something for longer, if you take a longer time risk, you should be compensated, you should be rewarded more. But because of the high interest rate environment over in the US, the shorter end of the yield curve is actually a lot higher, which is why the entire yield curve is actually inverted and not showing like a normal yield curve that you will see typically. So this is why market is pricing in a rate cut, because this part of the yield curve eventually, with a rate cut, will come down lower and will normalize to look like a graph, something similar to where our Malaysian government bond security yield curve is. So our Malaysian government bond yield curve is at the normal yield shape, where holding the shorter will give you about 3.5% for a 3-year government security bond, and holding a 10-year bond will give you about 3.82%. So that kind of sums up why we think that cash is king and bond is better. And I'm going to go to the third part of my segment. I'm almost at the last part. This is the second last part of my presentation today. So key market risks in 2024, what to look out for when you're making investment decisions of where to put your money in 2024. So one of the key risks will be extended period of high interest rate environment, which may lead to global recession and lead to persistent market volatility. So number two is again on the inflation thing that we spoke about, that although inflation is trending lower, but there is still lingering upside risk to the inflation outlook from ongoing geopolitical tension. Again, as mentioned before, energy prices are one of the key risks that you should look out for, because any movements up in energy prices usually will spike up inflation. And this would actually just look back to the first point, where if inflation is higher, central banks will maintain yields higher for longer and extended periods of high interest rates. It is going to weaken and slow down economic growth globally. Our third point is on China's economic growth and the ongoing challenges which we see may create spillovers. So China is one of the biggest trading partners after US globally, and it has lots of trading partners. So when China slows down, when demand from China comes down, the trading partner is going to feel it as well. So this is going to push down global growth even further moving forward. Another point that we see that we hear so recently so much is that sustainability and climate risk. So extreme climate change may disrupt supply chains, and this is going to impact especially so for sectors like agricultural and food. So when there is disruption in supply chains, when there is, especially for sectors like agriculture and food, this will feed again into creating an increase in upside pressure to prices, and increase in upside pressure will feed into higher inflation for longer globally. And the last point will be on Malaysia. So Malaysia seems to be doing quite well. Our OPR is steady at 3%. Our growth is steady. Our inflation is manageable. But there is this thing on subsidy rationalization. We get subsidized on fuel, we get subsidized on electricity, and some of like the basic foods as well. So any removal of subsidy rationalization may pose upside risk to inflation and slow down growth in Malaysia. So these are just some of the key market risks that you should look out for in 2024. So to conclude my presentation today, you will see that 2 points here. The first one being effects of high interest rates will see global growth slow down. We have been watching inflation in 2022 and also early parts of 2023, and now it's time to watch where things land. So whether it's going to be a harsh landing, where there are periods of global growth slowdown, weakening into recessions in economies, or it's going to be a soft landing, where we may just see negative quarter-on-quarter numbers for one period, for two periods, and then it bounces back right up. So all this will depend on the labor market, like how in the US, the labor market is so strong. In Malaysia, our employment numbers are also quite good. Our labor market is also equally strong. So this will cushion any harsh landing of weakening in global growth, the job market itself, consumer spending as well. So this is two data to look out for in terms of how harsh a landing can be or how soft a landing can be. Other effects of high interest rates also fit into higher borrowing costs, which also then fit into earnings and margin compression. And this is riskier to risky asset classes like the equities and junk bonds. So the final message here is really that, again, cash is king in 2023 and 2022, but bond is better. So bond market to deliver strong returns in 2024 as the rate hike cycle is over and rates have peaked. So bonds have always done better than FD over the long term, as I've shown in the previous chart. And bonds now are even more attractive because of the starting yield, and it's time to lock in the yield. And our expectation is for the bond market to return 5 to 5.5%, and this is a very stable and sustainable return from an asset class that we think that is something that you should have as an asset class allocation going into 2024. So with this, I end my presentation. I hope it was insightful and you're able to make better decisions for your money in 2024.
It is definitely very insightful. Thank you so much, Joanne. I like
Thank
your
you, Shane.
conclusions. Very short and very sweet. Okay,
Thank
concise.
you.
So if you have any questions to ask our speaker today, please write your
Mm.
questions at the chat box. Okay. And then we'll help to pose your questions accordingly. Don't write them at the Q&A box because I may got over swamped by all the messages that come in. All right. So Joanne, the first question that's on my screen is that how would you sum up the global bond market this year?
Okay, so I think the global bond market this year has been very surprising because usually when interest rates are high, when it goes up higher, you will see the tendency is that when yields go up, price comes down, and the return from the bond market is negative. But I think the most to sum up the global bond market this year is that it is a volatile year for the bond market. But in Malaysia, we are very surprised because the return, as I've shown earlier, year-to-date return is always almost 6%. So I think I would sum up in a way that it was good to put money into cash in 2022. It was good to put money in the early parts of 2023. But if you were to put money to work into the bond market in 2023 this year, that is exactly what you will be getting on a normal bond market return, where it's about 5 to 6%.
Yep, like what your tagline echoes, cash is king,
Yeah,
bond is better.
better. Yes,
2024.
definitely. Yeah.
Yeah. So the premise is that we lock in the yield right now, and when the yield tumble, there will be potential capital appreciation in the bond market.
Yes, because the yield is also higher right now. So any volatility in the market, this high yield is actually going to buffer any negative movements in terms of the return that you get from the bond market.
Talking about surprises, so what are the biggest surprises that you see in this year's market?
I think for this year, we are surprised by how resilient the US economy is. So I think this year and last year, because of how hawkish central banks have been, I think we've thought that there's going to be a recession. I think every single quarter, we predicted a recession. Every economist will have probably predicted a recession in the US economy or any other country that has seen rate hikes. But fortunately, we have not seen that. So there's such a big surprise is that no matter where the economy is going, in the US, where rates are, the labor market is still so resilient. So that is one of the surprises that we've seen this year.
I see. Talking about recession, just now your chart shows that inverted yield curve, which have been much talked about in the market for 2022 and 2023. So what do you think the likelihood of a recession in 2024? Do you think there will be a hard landing, soft landing, or there will be no landing at all?
So I think it depends on the country. So you see that probably I will go to like a more like bleak picture, which is in the Eurozone, where we've already seen negative numbers coming into the Eurozone numbers. Quarter on quarter is negative 0.1. Manufacturing sector activity, services sector activity are quite negative. So probably in the Eurozone, if there's nothing to push the market there, and if the central bank is going to continue to hike rates or even just pause rates for very long, then maybe the landing there is going to be quite hard. But in the US, because of the job market, how strong it is, wage prices are still going up, there is still very robust activity in terms of the consumer spending. So maybe in US, we may expect some sort of soft landing, maybe a quarter of recession numbers, but we don't think that it's going to be very harsh at all.
Right. So soft landing is more likely.
Okay. That is correct.
So what would be the main investment themes for the fixed income market next year?
I would say that it would be the time to go in for the market for next year. So the team would be really, I think, locking in yield when it is still there. you should lock in yields before the central banks actually start to cut rates. So that was one of the investment team. And also when you're invested into the bond market, you should be very aware of what sort of bonds you're invested into. Like earlier, I've mentioned that higher interest rates do actually impact a lot of margins, a lot of profit margins. So if you're going to be invested in the bond market, be invested either in the risk-free environment or in very strong credits. So probably one of the team is be invested in the fixed income market, but remain vigilant in terms of corporate credit. I think another team that we'll see next year will probably be sustainability. I think this is one of the team that it's not only in fixed income, it's also in equities and probably in other markets as well, is that sustainability is a key driver of growth in moving forward. And probably if you want to see some sort of where more issuances will come out from in the bond market or even equity, it will be sustainability and ESG.
Thanks for sharing your perspective, Joanne.
Mm.
Um, Now, talking about bond investing, right? And there are
Mhm.
different tenures. So which tenures do you recommend?
Okay. So now, I mean, I guess I will share a bit more about what our strategies is. From a fund house perspective view, we are a fixed income fund house, and we always make sure that we make the best decision choices for our clients. So for now, our target sort of tenor maturity bucket that we think we should be invested in for the Malaysian bond market will be about the 3 to 5 years duration. So we feel that the market is still quite volatile, moving into the end of 2023, the final month of 23 and 2024. So the longer duration you take, the more risk you take, then that will impact your returns slightly. So for us, we think that the best part of the yield curve to be in will be about 3 to 5 years for the Malaysia bond market. But if you're going to be going into the advanced economy where interest rates are quite high, like in the US or US, Australia, or even in the UK, then maybe in the shorter part of the yield curve would be even better because as you see, the yield curve in US is inverted. So it makes sense to be in the shorter end of the yield curve when the yield curve is inverted.
Okay, thanks for sharing your perspective, Joanne.
Hmm.
Joanne, just now you mentioned about the risk of targeted subsidy or subsidy rationalization plan would risk any upside surprise to the inflation.
Yeah.
So the next question by Ang is that with less handout from the government, do you think that the GDP will trend lower?
I guess, okay, so the question is quite specific to handout from government. I think in general, it really depends on the quantum of where this subsidy rationalization is. So for Malaysia, the biggest subsidies that is being spent on every year is really from that fuel subsidy. And I think also maybe perhaps a little bit more on electricity. And then the third part of subsidies will probably be from all the basic food subsidies that we have in place. So depending on the quantum, so I think handout from government also then isn't the biggest spending of the government. So maybe it would not impact inflation and GDP too much if we're going to be quite specific on this part of subsidy rationalization.
I see. Well, talking about the Fed being dovish or start to cut rate in the second half of 2024, we noticed that every time when the Federal Reserve cut the interest rate, the stock market may fall as the fear of hard landing. Do you think this time it may happen?
Okay, so there is a FOMC decision coming up on the 13th, which again, market is pricing in no changes to the interest rate. I think the correlation is always that there is a fear of hard landing, but as mentioned, the job market is very strong. So I think as an investor, if you are to be invested into the US market or any market, you should always look at fundamentals. You should always look at from an economic perspective, from a macroeconomic perspective, when the Fed cut rates, it is actually better because when they cut rates, the borrowing cost will come down slightly, and it's actually good for the business. So business usually they do borrow quite a bit. So when profit margins are good, that in general should correlate to better equity pricing and better correlation to where equity should be more positive. So as an investor, I think you should always take out the noise of where the knee-jerk reactions are. to a policy rate decision or a headline. And if you were to be invested, you should be invested in the longer term and to look at things from more of a fundamental and an economic point of view.
Thanks, Joanne. The next question by Chu is that will the market be able to absorb higher US Treasury supply?
Oh, okay. I think you have seen that has impacted yields. So I think that the market, yes, it can absorb, but what level can it absorb at? So I think the recent trend is that US market has been increasing their debt issuances a lot in the US Treasury market, and hence not only because of the hawkishness in terms of Fed policy rates that the yield is higher in the US, it is also because of the more bigger supply of government bonds in the US Treasury market over in the US. So yes, I think that the market can absorb the supply, it can absorb the issuances, but it may absorb it at a higher yield. So there is something that if you're invested in the US Treasury market, you should look out for, because it might spike up yields whenever they issue bonds. It might continue to be higher. And again, when yields are higher, it is not good for bond investments.
Thanks, Joanne. Now, we know that when we invest in bond funds, there might be upfront fees that will be chargeable.
Oh, okay.
And the fee sometimes will range between 2 to 4%, as remarked by Andrew. So
Yes.
would that neutralize the yield that is returned, the yield return?
Okay. Okay. So bond funds. So yes, generally there may be some upfront fees. So in Opus, we do not charge any upfront fees. But if you are invested into a particular bond fund that charges upfront fees, does it neutralize? Yes. So I think a 2.2 to 4% is generally quite high, because as seen in the chart that I've shown earlier, annualized return of a bond fund is usually about 5 to 6%. And at very good times, it can go to 8 to 9%. So yes, it will neutralize because it will just net off the fee. So if, for example, if your bond fund is returning 5% and you're charged 4%, your net return is only 1%. So I would advise you to actually go to funds, do a bit of research. I think there are a lot of platforms out there that you can compare. I think there are also a lot of articles that you can read on what are top funds to invest into in the bond market. But you can also look at Lipper tables, you can look at the H Weekly to see what funds are doing well, and you can call the salespeople to ask more about the fees, because if you are charged 4%, then I think it's too high, and I think it is not worth going to that particular fund. You should be looking out for other funds that may charge you no fee or lower fees.
Yeah, if upfront fee is 4% plus the asset management fee, extra administration fee.
Yeah, this is gonna be like the thing.
You got less than 1% kind of return.
Yeah, it's better to put into a savings account.
All right.
Yeah, so but I would really say that so for Opus, we do not charge upfront fee. But if you are invested in a bond fund that charges upfront fee, I would recommend for you to just shop around, because nowadays information is so readily available. So you should use that information and shop around to make sure that the money that you're invested in is really the fund is giving you the best return that you can for the money that you're invested into.
Yeah, Bursa Malaysia also launched the Bursa Marketplace fund platform. You may go there and check out. There are a few houses that publish the funds there. You can check out all the funds information from Bursa Marketplace. Since time is running out, let's do one last question.
Okay.
Now, the US debt, the United States of America is reducing the holdings in the Treasury at the moment. So how will it affect the DXY? I think the current.
This is a currency.
And
Okay,
the interest
okay.
rate short term and long term. If I interpret the question correctly.
Okay, sorry. Let me just look at Ang's question.
Yeah.
Okay. I think probably Ang, you're asking about the US Treasury and other countries reducing the holdings of US Treasury. So
like
I think
doing
now
QT.
Okay, so the reason why DXY has been so strong in the US market is because of how high interest rates are. So logically, money will just flow into the US market. So as some countries, maybe they prefer to diversify out of US Treasury, they may want to buy the government bonds of other countries. So for example, they may switch from US government bonds to our Malaysian government bonds, because our yields are actually quite good as well. Our 10 years doing almost 4%. So that will bring down DXY because there is less demand for assets in the US. So when there's less demand for assets, there's less demand for US dollar. So the DXY should trend down. And in terms of interest rate, when there's less demand for a bond, the yield will generally go higher.
All right, thank you so much, Joanne. So let's conclude our session today.
Okay.
So let me pull up my screen first. All right. So thank you so much to everybody for tuning in until the end of this webinar. So ladies and gentlemen, you just heard from the investment manager from Opus Asset Management, Miss Joanne Gan. All right, thank you so much, Joanne, for spending your time with us today.
Thank you so much for inviting me, and thank you everyone who have tuned in today to my talk.